Welcome to IFRS Meaning. Today we will talk about what is a contingent consideration in a business combination.
What is a contingent consideration in a business combination? In 2005, the Cardiff Group, a multinational company dedicated to selling sugary drinks, acquired 70% of the equity interest of a company located in Southeast Asia. This is with the objective of expanding its operation and entering this market. This group paid a sum of $553,000 million for the shares of this Asian company. This operation is known as a business combination, and the sum paid, equivalent to $553,000 million for the shares of this company, is known as the consideration paid. So, what is a contingent consideration in a business combination? Using the same example that we have been analyzing, if Cardiff Group decides that in addition to the $553,000 million, it will pay an additional sum of $50,000 if in the next 4 years the entity located in Asia increases its net profit by a certain percentage, or the sales are increased by a certain level, this is known as contingent consideration. Let's see a practical example. In year 1, Company A acquires 100% of the equity interest of Entity B for $10,000. Entity B's identifiable assets are $19,000 and liabilities are $7,000. Furthermore, Company A is willing to pay an additional $5,000 if at the end of year 2, Entity B's sales increase by 10%. The fair value of the consideration in the business combination at the beginning of year 1 equals $4,500. And the fair value at the end of this same year amounts to $4,700. At the end of year 2, Entity B's sales increased by 15%. To determine the value of goodwill, we must compare the total consideration versus the acquiring entity net identifiable assets and liabilities. The total consideration comprises the consideration paid plus the fair value of the contingent consideration. As you can see in the example above, the acquirer entity must recognize goodwill resulting from paying a higher value for the identifiable assets and liabilities of Entity B. Since the contingent consideration meets the definition of a financial liability, changes in its fair value must be recognized in profit and loss. In conclusion, the entity must recognize a goodwill of $2,500. In addition, it must recognize a contingent consideration equivalent to its fair value at the beginning of the business combination by $4,500. After this, it will be necessary to adjust this contingent liability until reaching the amount paid of $5,000. Since the entity achieved the proposed objective, it will be necessary to write off the contingent liability. I hope this example has been handy for you, and I will see you in the next video.
If you want to learn IFRS, be an expert and make a difference, we remind you to review our course on International Financial Reporting Standards. The course has more than 270 explanatory videos, more than 370 analysis questions, personalized advice, and real-world examples and cases. In the video description, you can find all the course information. Cheer up, and take your professional career to the next level.